Welcome to the Pro Ticker Deep Dive. So we have a core question for you today, and it's a big one. What if cybersecurity is no longer purely a technology story?
Hmm.
Because for years, when you looked at this sector, the general perception was, okay, cyber stocks belong in that high growth, really high volatility software bucket.
The feast or famine cycle.
Exactly. You just
Yeah.
accept that. But based on the data we've been analyzing, that mental model is not just softening. I think it's actually cracking.
It absolutely is. We've seen this profound structural shift over the last, say, 18 to 24 months.
Right.
Cybersecurity is now behaving less like some speculative cutting-edge tech and far more like, like regulated critical infrastructure.
You mean like utilities or healthcare?
Precisely. Think healthcare.
Right.
The spending is defensive, it's essential, it is recurring, and this is the crucial part for enterprises. It's now completely non-negotiable.
That reframes everything.
Yeah.
Because if you stop looking at it as just innovative software that needs the next hot gadget to drive sales, and you start seeing it as a mandatory utility,
The entire valuation thesis changes.
you're moving from boom and bust to something much more predictable, a foundational necessity.
Exactly. So our mission for you today is pretty simple. We are going to unpack this structural realignment. We'll look at the data that really proves this analogy to healthcare, and then talk about what it means for capital allocation.
Okay, so how should you balance exposure between the high-growth plays and these new, stable, defensive names?
That's the question we're going to answer.
All right, let's get into it. Let's unpack that structural shift first. The old investment model was, like you said, trying to bet on who had the slickest new security widget.
Right, in the next 2-year innovation cycle.
But now the spending is shifting to essential, recurring payments. How does that create a more predictable economic model?
Well, it translates directly because the spending is now decoupled from an enterprise's discretionary IT budget.
Meaning it's not a nice-to-have anymore.
Not at all. And the parallel to healthcare is really the key insight here. I mean, think back 2 decades ago. Healthcare was fragmented, it was competitive, mostly driven by innovation. But then the regulatory edifice started hardening globally.
You're talking about things like HIPAA in the U.S.
HIPAA was the start, yeah, but now we have these comprehensive frameworks all over the world. Enterprises today face mandatory compliance requirements like the EU's NIS2 directive.
And that's the new far-reaching law for critical infrastructure in Europe, right?
It is. It's a huge deal. Or you look at something like HITRS CSF, which is a major framework for healthcare organizations everywhere.
So these are not just, best practices. These aren't voluntary upgrades.
No, absolutely not. They are legal requirements to operate. They are required for licensure, for your insurance coverage, and to avoid just massive fines.
I see.
So this is what makes the spending defensive and incredibly sticky. A hospital cannot legally operate without certain standards of care. In the same way, an enterprise in a critical sector can't operate without meeting these security requirements.
Because the cost of a breach, the financial and reputational hit, it's just an existential risk at this point.
It is. So cutting the security budget becomes impossible.
Okay, I see the parallel. But here's a question. Doesn't this mandatory spending also maybe slow down innovation? If you're forcing everyone onto older, proven platforms just to be compliant, does that squeeze out the real cutting-edge players?
That is a sharp question, and it really speaks to the duality of this market, which we'll definitely get into later. But what we're seeing right now is this shift in boardroom attention. It's moved way past the question of should we invest in cybersecurity to how do we implement foundational architecture?
Like zero trust.
Exactly, like zero trust. We've moved from this, fantasy of total prevention, like building a big wall and hoping it holds, to the reality of continuous monitoring and resilience.
And you have to pay for that resilience every single year.
Year after year, through subscriptions, upgrades, monitoring services. That shift is the very definition of a sticky recurring revenue stream. It completely changes the quality of the revenue base for these companies. And the necessity driving the spending is massive. We have the data to back up this structural thesis, and it's not fueled by that speculative hype we saw during the pandemic.
No, this is driven by legal and operational mandate.
Exactly.
Give us the numbers. What's the scale of this necessity?
Okay, so the broader cybersecurity market. It's projected to expand from about 194 billion USD today, to get this, 563 billion by 2032.
Wow.
But here's the most telling indicator. The slice of the market under the most acute regulatory pressure,
Yeah.
healthcare.
Right.
That sector alone is projected to grow from about $32 billion in 2025 to over $126 billion by 2034.
That's a compound annual growth rate over 16%.
16%.
Yeah.
A single regulated sector. It's massive.
And this is where the human element really clarifies that utility analogy, because the stakes are now, well, they're existential.
They truly are. The threat environment is forcing the issue. In 2024, 92% of healthcare organizations experienced a cyber attack.
92%. That's just the cost of doing business now.
It is. And the attacks are getting worse. Ransomware surged 30% in 2025 against healthcare.
And we've all seen the consequences. I mean, the Synovus attack in the UK, that didn't just leak data. It paralyzed care delivery across major London hospitals for weeks.
And the Ascension attack compromised 5.6 million patient records.
This isn't just about financial loss anymore. This is about life safety.
That operational paralysis,
Yeah.
that is the single most important driver for boards now. You cannot run a critical business without resilience, and security is the bedrock of that resilience.
Which is why the regulators are moving so fast.
So fast. And beyond NIS2, accountability is shifting. I mean, data firms like FICO, which handle unbelievable amounts of sensitive data, are now facing the possibility of direct liability for breaches affecting their customers.
So when we talk about resilience, a foundational layer is zero trust architecture. Is that showing real infrastructure level growth, or is it still just hype?
Oh, it's pure infrastructure adoption now. The global zero trust market was valued at $19.2 billion in 2024, and it's growing at over 17% annually.
Wow.
Implementing Zero Trust, which is really about foundational identity and access management,
Yeah.
it's becoming the operating system for enterprise security.
That makes perfect sense. Identity is foundational. You can swap out a firewall,
Yeah.
but pulling out your core identity backbone.
It's operationally catastrophic,
Yeah.
which gives these vendors incredible stickiness.
Incredible stickiness.
Yeah.
And the macro signal confirming all this came from that Morgan Stanley survey.
Yes. Where CIOs, chief information officers, said they expect cybersecurity spending to grow 50% faster than overall software spending.
50% faster.
In a budget showdown, security gets the protected dollars. That tells you everything you need to know.
Okay, so that signal is crystal clear. Money is flowing into this sector no matter what broader tech sentiment is doing. So for you, the learner, trying to allocate capital here, we need to make this critical distinction. The market is dividing into two lanes.
Right, two lanes, each with a very different risk and reward profile.
So lane one is for investors still betting on that aggressive high-growth innovation, the classic momentum play.
And lane two is for those seeking the stability and defensibility of this new infrastructure thesis.
Let's start with lane one, the growth players. And the gold standard here has to be CrowdStrike.
Oh, absolutely.
They pioneered that cloud-native, AI-first platform, Falcon. They generate a massive 95% of their revenue from subscriptions.
And their recurring revenue is now over $4.6 billion annually. The numbers are just staggering. They're still projecting revenue growth well above 20% year over year.
And their valuation reflects that thesis, right? It's all about market share expansion, not necessarily margin expansion today.
100%. I mean, the stock appreciated 1,340% in 6 years. It went from a $63 IPO price to almost $490 by October 2025. The whole investment thesis relies on their platform continuing to expand into identity, cloud security. They are the definition of a growth at all costs momentum stock.
Okay, now for lane two. Stability, defensibility. This is for investors looking for repeatable cash flow and less volatility.
Right. And here we're looking at companies with proven, repeatable revenue, deep customer bases, and a real focus on capital efficiency. Fortinet is the classic example. Their quarterly revenue recently topped $1.6 billion, and their PE ratio is around 34, which is much more rational than the pure growth plays. They focus on generating positive operating margins and steady, predictable returns.
And what about the huge platform companies that are sort of trying to bridge both of those worlds?
That's Palo Alto Networks. They are leading the charge on what they call platformization. They're not just selling products. They are integrating all these companies they've acquired to build a unified, indispensable offering.
Across zero trust, attack surface management, all of it.
All of it. Their goal is to make the customer feel like switching away would be impossible. And then, of course, you have Zscaler, which is a key pure play in that identity and access niche.
What's so fascinating here is the underlying business model shift that's enabling all this stability.
Yes. We are finally moving away from those huge, unpredictable one-off software licenses that caused so much volatility in earnings.
That model is fading.
It's being replaced by subscription models with high renewal rates and the rise of managed detection and response services. These recurring revenue streams structurally reduce volatility. It makes the financial outlook far more predictable, much like billing for a utility.
Okay, let's go back to that healthcare analogy to talk about the moat, that protective barrier.
Yeah.
When an enterprise is evaluating a security vendor, how is that decision different from buying, say, a standard cloud service?
It is fundamentally different because the cost of failure is just so much higher. An enterprise evaluates security providers the same way they'd evaluate a medical device manufacturer.
So it's about regulatory capability, proven resilience, not just the price.
Exactly. And once that architecture is deployed,
Right, what happens then?
once a large enterprise deploys a comprehensive, integrated zero-trust architecture, switching vendors becomes operationally catastrophic. The sheer cost and risk involved in ripping out and replacing that foundational system creates a massive barrier to entry.
That operational entanglement is the moat.
That's the moat.
And if the moat is that high, that has to give them undeniable pricing power, right?
Absolutely. Think about it. The potential cost of a breach, we're talking hundreds of millions in downtime, fines, litigation. It exceeds the annual licensing fee by orders of magnitude.
So for the buyer, the cost of not paying is way higher than the license fee itself.
Far higher. Therefore, vendors can maintain pricing power. They can raise prices incrementally, even when other software markets are under pressure. The buyer simply cannot negotiate down the price of survival.
So just to recap the bull case, mandatory spending, strong regulatory tailwinds, massive sticky installed bases, and spending that's growing faster than general IT. It sounds almost too good to be true.
Well, and to maintain balance, we have to look at the other side. There are essential counterpoints here, real bearish risks you need to watch.
Okay, let's hear them.
The first major one is M&A integration risk. When big corporations merge, combining their fragmented, dissimilar IT environments creates these massive vulnerability windows.
So the security provider has to be able to handle that complex integration perfectly.
Perfectly without introducing new risks. It's a huge challenge.
What about the human element?
That's the second critical risk, the talent shortage. The industry simply cannot hire enough skilled analysts and engineers to keep up with demand. This forces labor costs up for the vendors, which could compress margins, and it limits how fast customers can implement new systems.
And that shortage probably connects to the third point, customer consolidation.
Precisely. The biggest enterprises are building these sophisticated in-house security teams, but even they realize they can't manage 20 different specialized vendors, so they're consolidating their spending onto fewer massive platforms.
Like Palo Alto or CrowdStrike.
Exactly. So if you're holding a small, pure-play vendor, you need to see a clear story for how they integrate into that ecosystem, or they will be squeezed out.
Then there's the political risk. If security really is a utility.
That's the fourth one, regulatory backlash. If security is fully deemed essential infrastructure, regulators might eventually step in to cap licensing fees, or maybe mandate government-backed solutions like with public utilities.
Which would crush margins across the board.
Dramatically. And finally, you have that critical valuation risk, especially for the growth players in Lane 1.
CrowdStrike.
Yes. CrowdStrike's extraordinary valuation assumes continued aggressive growth above 20% annually for years. That is the central risk. If growth disappoints even modestly, the repricing could be harsh and instantaneous. You have to watch those quarterly metrics like a hawk.
Okay, let's bring in the technicals to support this whole infrastructure thesis. We can look at the First Trust NASDAQ Cybersecurity ETF, CIBR. It holds a basket of, what, 33 companies?
33, yeah, weighted toward the established platforms.
Great.
And the CIBR chart technically confirms this pattern of infrastructure growth. Its returns about 29% in 2025, a 3-year cumulative of around 56% are solid but consistent.
And crucially, its volatility is materially lower than the broader NASDAQ.
Much lower. And that lower volatility is the signature of defensive spending. It tells you that institutional money is not panicking. They see the dips as buying opportunities. The sector held its ground far better than general tech during those pullbacks in March and August of 2024. Technically, we see support found consistently 15 to 20% below recent peaks.
So institutions are stepping in to buy.
They are, and selling volume during those drawdowns is consistently lower than buying volume during the rallies. That is a strong bullish signal of conviction. This is a long-term hold, not a short-term trade. The 200-day moving average is sloping upward. It's an established uptrend.
So let's bring it all together. What does this all mean for you, the learner, looking to invest in this space?
It means cybersecurity has, I think, unequivocally graduated to essential infrastructure with defensive characteristics. The optimal strategy here is what we call the barbell
Well,
strategy.
barbell, so you need exposure to both lanes.
Exactly. You use the pure play growth names like a CrowdStrike or a Zscaler for your upside
There
exposure.
are the innovation and emerging domains like identity.
Right. And then you allocate equally to the established capital efficient platforms like a Fortinet, Palo Alto, or just the diversified CIBR ETF for stability, predictable cash flows, and defensive protection during downturns.
So the big picture here is that the market structure is solidifying. We are moving from this venture-backed chaos to what looks more and more like a regulated oligopoly.
That's the bottom line. Enterprises have no choice but to spend, and that spending is protected by regulation and catastrophic switching costs. So I'll leave you with a final thought to consider. Given that the addressable market is, essentially infinite, every government, hospital, and company needs continuous protection, how will the next wave of AI-powered regulatory enforcement further solidify the moats of the current platform leaders?
That is the question that will define the next decade of returns in this space. See you all in the next Pro Ticker Deep Dive.